Have you ever wondered who really controls the rules of money? Or why some people always seem to get richer while most stay stuck chasing the same paycheck? Money feels like it should be simple. Earn it, save it, invest it, grow it. But if it were that simple, why do so many lose money in the stock market? Why do entire economies collapse while a few walk away richer? There's a hidden world behind every dollar in your pocket. A world shaped by history, secret deals, and people who know how to bend the game in their favor. From dusty old docks in Amsterdam to the blinking screens of Wall Street, the same patterns keep repeating. Control the rules, own the monopoly, keep everyone else guessing. At the Passive Path, we believe it's time to see behind the curtain, because the game doesn't just belong to billionaires and bankers. It belongs to anyone who knows the real story. Today we're going to dig into that story, to how paper money became trusted without gold to back it, why fear and greed drive markets higher than logic ever could, and how you can learn to protect your wealth and grow it. If you want a life where money works for you, not the other way around, keep listening, because the rules you've been taught might not be the real rules at all. And once you see the truth, most people think investing is about buying low and selling high. That's what every book and every so-called expert repeats. But the truth is, buying low and selling high sounds easy until fear or greed takes over. Look at the dot-com bubble. Companies with no profits saw their stocks soar. People poured in money, convinced they'd get rich. When the crash came, they lost everything. Or think about meme stocks. One day, social media pumps up a stock everyone's talking about. The next day, it crashes. The story repeats over and over. People think they're smarter than the crowd, but the crowd always drags them back in. Most investors lose because they don't control their emotions. They follow the news, they follow tips, they follow hype, they sell when they're scared. They buy when they're greedy. This has been happening for hundreds of years. Even in the earliest days of the stock market, fear and greed drove prices up and down. The people they were the calmest, they knew how the game was played, they watched others panic and pounced on opportunities. Look at today's markets. Crypto prices shoot up and collapse. Tech stocks fly high and then sink. Investors jump from one hot trend to the next, but history shows it's always the same pattern. Excitement rises, prices spike, then the music stops. Someone always gets left holding the bag. It doesn't mean you shouldn't invest. It means you have to see past the noise. You have to know what you own. You have to understand the real value behind the price. If you don't, you're gambling, not investing. At the Passive Path, we believe knowledge is power. The more you know about how markets really work, the safer your money will be, and the better your chances of growing wealth that lasts. Because the real secret isn't just buying low and selling high, it's knowing why prices move in the first place, and how the same forces keep repeating. We are about to dive into where stocks came from, and how the very first investors. Let's go back 400 years, to a time when ships ruled the world, when the seas were the highways of trade and power. Back then, the Dutch were masters of the ocean. Their ships carried spices, silk, and precious metals. They were known as the wagon drivers of the seas. But shipping was risky. Pirates, storms, wars, and shipwrecks wiped out fortunes overnight. No single merchant wanted to risk everything on one voyage. A group of Jewish merchants saw a way around this problem. They wanted to own the shipping trade. They wanted control of the sea routes, but they didn't have enough money, so they did something nobody else had tried at scale. They created a company and sold pieces of it to anyone willing to invest. This company was called the Dutch East India Company. It became the world's first publicly traded company. Investors could buy shares. Those shares meant owning a piece of the company's future profits. Ordinary people, they hoped the company would make money, and they would collect a share of the profits. A man could become wealthy without ever leaving his home, just by owning pieces of a shipping empire. The Dutch East India Company built huge fleets. They controlled ports. They controlled spices. They became powerful beyond imagination. People lined up to buy shares. Paintings from the time show a maid holding a purse of savings. That was the life savings of Amsterdam's mayor. He invested it all in the company. The idea spread fast. Other companies copied it. A new world was born where anyone could become an investor. People believed their money could work for them. They could get rich without lifting a finger. The Dutch East India Company's message was simple. Give us your money. We'll make it grow. This dream of wealth still lives on today. Every time someone buys a stock, they're chasing the same promise, to let money multiply. Because once shares existed, people started buying and selling them, not just to earn profits from trade, but to profit from rising prices. The first stock exchange was born in Amsterdam. People gathered to trade shares daily. News and rumors spread like wildfire. One day, fear would crash prices. The next, hope would send them soaring. A new game began. A game that still shapes our world today. The game of speculation. This is where the roots of today's stock markets lie, and where the seeds of bubbles and crashes were planted. Because money, greed, and human emotion have never changed. At the Passive Path, we think it's vital to know this history, because the past always leaves clues about how to navigate the future, and how to avoid becoming just another victim of the game. Next, we're going to talk about why monopolies are so powerful, and why the people who own monopoly means having control. Control over products, control over prices, control over who gets to play the game. The Dutch East India Company didn't just ship spices. They controlled the entire sea trade. They decided who could sail and who couldn't. They held the licenses for ocean routes. No license meant no business. That's real power. Today, nothing has changed. Look at Apple. They dominate smartphones. They set prices. Competitors follow. Look at Microsoft. They own the world of business software. Most offices can't work without it. Look at Google. They own search. Billions of searches happen there every day. That's monopoly power. Monopoly makes money flow in one direction, toward those who hold control. Think about real estate. Cities grow. Space shrinks. Land becomes scarce. That's why real estate giants buy huge pieces of land. They hold it. They wait. They release it slowly. Prices rise because supply stays low. In Hong Kong, land is precious. Developers buy land and don't sell. Population grows. Demand rises. Prices shoot up. Only a few hold the keys to the market. That's how monopoly works. The game is about making the supply small and keeping demand high. That's why the richest often own what no one else can copy. A brand, a patent, a piece of land, a piece of the digital world. At the Passive Path, we talk about passive income, but true passive income comes easier if you own a monopoly or at least a small corner of a market no one else controls. Because when you own the rules, you own the money. Monopoly isn't illegal. It's just smart business. If you want to build real wealth, study how monopolies work. Ask yourself where the world has bottlenecks. Ask who controls them, and see if there's a piece you can own. Next, we'll explore how people raise money when they don't have enough of their own, and why borrowing power. Most people think the rich get rich because they already have money. But that's not the full story. The rich get rich because they know how to borrow power. They know how to use other people's money to grow faster. When the Dutch East India Company wanted to build a shipping empire, they didn't have enough gold, so they sold shares. They borrowed money from the public and turned it into ships, sailors, and global trade. That's borrowing power. Today, startups do the same. They raise money from angel investors or venture capitalists. They pitch a vision. They promise growth. Investors give them cash, and they grow without using their own money. Borrowing power isn't just about loans from a bank. It's about getting people to believe in your idea and to give you their money to make it happen. Banks lend money for businesses too, but banks love safety. They want collateral. They want to know they'll get paid back. So smart business, they show banks they're safe, or they go straight to the public markets and sell shares. Big companies do it all the time. They raise billions without giving up control. That's why they stay ahead. Because while small businesses save pennies, big businesses raise millions. Think about real estate developers. They find a piece of land. They plan a building. They don't pay for it all themselves. They bring in investors. They borrow from banks. They pre-sell units before the building exists, all to reduce how much of their own money is at risk. This is how fortunes are built, by borrowing power, by multiplying what you have through other people's resources. But there's danger too. Borrowing money means you owe money. If things go wrong, debts can crush you. So smart entrepreneurs and investors use borrowed money carefully. They know how much they can afford to lose. At the Passive Path, we believe borrowing power. Use it wisely and you can grow faster than you ever thought possible. Use it recklessly and you can lose everything. Next, we'll talk about how fear and greed have always been used to control markets, and how the same fear and greed are the oldest tools in the financial world. They make people rush in or run away. The Dutch East India Company knew how to use both. When rumors spread that their ships were lost to pirates, panic hit the market. People sold their shares cheap. Prices crashed. Then news arrived that the ships were safe, or that they found new gold. Suddenly everyone wanted back in. Prices soared. Those who spread the rumors bought low and sold high. This game hasn't changed. Look at modern times. A single tweet sends crypto prices flying up or crashing down. News headlines spark fear, markets fall. Then good news comes, and markets rise again. People can't help themselves. Fear makes them sell too soon. Greed makes them buy too late. Smart investors watch this cycle. They wait for fear to create bargains. They wait for greed to create bubbles. And they stay calm while everyone else loses control. In the old days, they wore fancy hats and carried ledgers. They looked like rich merchants, but they were actors, hired by the company to look important, to make people think business was booming. People saw them and believed the company was safe, so they bought shares. That's how confidence was created, and how prices were controlled. Today, financial influencers play a similar role. They talk up stocks. They talk down stocks. They create fear and hope, so others will act while they profit. This is why news and social media can't be your guide, because often the news is part of the game. At the Passive Path, we believe knowledge protects you. When you know the patterns, you don't fall for the tricks. You don't panic when the market drops. You don't chase hype when prices skyrocket. You move on your own plan and let others get caught in the storm. Next, we'll look at how governments learned to borrow money and how the birth of bonds. Long ago, kings ruled by gold and armies. But even kings ran out of gold. Wars cost money. Armies needed to be fed. Weapons needed to be bought. Kings turned to wealthy merchants for help. In Spain, Jewish financiers made a deal with the king. The king needed money for war. The merchants offered a solution. They suggested borrowing money from the people. In return, the king promised to pay back with interest. That promise became the first government bonds. A piece of paper that said, "Lend me money today, and I'll pay you more tomorrow." People trusted the king's word. They gave him their savings. The king got his army. The merchants earned interest. This gave birth to national debt and a new power behind the throne. Because whoever funded the king controlled him. If the king failed to pay, he risked losing his crown. Merchants could demand tax rights or trade privileges. The king might stay on the throne. But this game spread across Europe. Other countries copied it. Soon governments everywhere were selling bonds. Wars got bigger. Debts grew larger. The same pattern lives today. Look at the United States. It borrows trillions. People keep buying U.S. bonds because they trust America will pay back. Treasury bonds are called safe. Banks, pension funds, and nations hold them. The system runs on faith. Faith that governments honor their promises. But debt comes with risk. Too much debt weakens a country. If faith breaks, chaos follows, just like in ancient times. At the Passive Path, we know bonds can be part of smart investing. But they're not risk-free. No investment ever is. Bonds tie your money to the fortunes of nations. And sometimes, nations fall. Next, we'll talk about how money itself changed. From heavy gold coins to pieces of paper. And gold was once the only money people trusted. Heavy coins, shiny bars, real weight in your hand. But gold was hard to carry, hard to store, and impossible to split into tiny amounts. Enter paper money. A promise on paper that you could exchange it for gold. In England, a man named John Law changed everything. He believed money didn't need gold behind it. He thought trust was enough. If people believed paper was money, then it was money. He started printing paper notes. People used them instead of gold. At first it worked. Trade increased. People felt rich. But soon too much paper money flooded the economy. Prices rose fast. Trust collapsed. The system crashed. People lost fortunes overnight. John Law fled for his life. Paper money nearly destroyed the country. But the idea didn't die. Other countries copied it, because paper was easy to print. Gold was limited. Paper could pay for armies, for wars, for building nations. As long as people trusted their paper, America used to tie the dollar to gold. 1 ounce of gold equaled $35. People believed every dollar had gold behind it. But in 1971, that ended. America dropped the gold standard. Dollars became pure paper. Nothing backed them except faith in the U.S. Yet the dollar remained strong. Because people around the world kept believing in it. They traded oil in dollars. They saved money in dollars. Trust replaced gold, and made the dollar the world's money. But trust is fragile. If faith in a currency dies, the money becomes worthless. Look at Venezuela, or Zimbabwe. Paper money became worthless because trust vanished. At the Passive Path, we teach that money is more than paper. It's belief, it's confidence, it's the story people agree to follow. And that's why money can be powerful or dangerous. Next, we'll talk about how bubbles form and why even the smartest people. Bubbles start with a simple idea. Something new appears. People see money to be made. They rush in, prices rise fast. More people join in. They fear missing out. Prices keep going higher until reality hits. Then the bubble bursts and fortunes disappear. In the 1600s, it was tulips. Tulips became symbols of status in Holland. People paid more for rare bulbs than for houses. Farmers stopped growing food. They grew tulips instead. Then buyers vanished. Prices collapsed. People lost homes, businesses, and life savings. In England, there was the South Sea Bubble. A company promised riches from trade in South America. Shares soared. Politicians invested. Even the king joined in. Then news came. There were no profits, no trade, just empty promises. Shares crashed. Investors went bankrupt. The bubble swallowed fortunes. In recent years, bubbles returned. .com stocks in the late 90s. People believed the internet would make money forever. Then the crash came. Investors lost trillions. In the crypto world, bubbles rose and fell. Bitcoin soared, then fell. NFTs sold for millions. Then buyers vanished. Bubbles happen because humans dream big. Greed blinds reason. People believe prices will rise forever, until they don't. Even geniuses fall for bubbles. Isaac Newton invested in the South Sea Company. He lost his fortune. He said he could predict the motion of stars, but not the madness of men. At the passive path, we believe bubbles can be avoided. If you know how to spot them, ask yourself questions. Is this price supported by real value, or just hope? Is everyone talking about it? Are people buying because of fear or greed? If the answer is hype, be careful, because bubbles always end, and those who stay in too long pay the price. Next, we'll talk about why most investors should stay cautious, and how protecting. Most investors think the goal is to make as much money as possible, but the real goal is to keep your money safe first, because losing money hurts more than gaining it feels good. A loss of 50% means you need a 100% gain to get back to even. That's why protecting your capital matters most. Some people chase hot stocks. They hear about a company doubling overnight. They rush in, they ignore the risks, and sometimes they win, but more often they lose, because markets punish greed and reward patience. There's a saying in investing. It's called the greater fool theory. You buy something at a high price, because you think someone else, a greater fool, will buy it from you for even more. That works until there's no fool left. Then prices collapse, and you're the one holding the losses. Liquidity matters too. Liquidity means how easily you can sell what you own. Stocks in big companies are liquid. You can sell. Real estate takes time to sell. Private businesses can't be sold overnight. If you need cash fast, illiquid investments trap you. So smart investors always keep part of their money in liquid places, so they can handle emergencies. Professional investors use stop-loss orders. They decide how much they're willing to lose. If a stock drops below that price, they sell. It protects them from bigger losses. Casual investors rarely do this. They hold on, hoping things get better. But hope is not a strategy. At the passive path, we believe rules keep your money safe. Know how much you're willing to risk. Know when you'll sell. Know why you're buying in the first place. Because if you don't, you're gambling, not investing. Quick riches tempt everyone, but real wealth comes slowly, and from avoiding big losses along the way. Next, we'll look at why starting to invest with too little money can be risky, and why some people should. A lot of people want to start investing right away. They hear advice to start small, to build experience, to learn by doing. But starting too small can be dangerous, because small money can't handle big shocks. Imagine saving a few $1,000s. You put it all into stocks. Then an emergency hits, your car breaks down, a medical bill arrives, you need cash, but the market is down. You sell at a loss. Your savings vanish. That's why having cash reserves matters. An emergency fund protects you, so you don't touch your investments when life surprises you. Some people think investing can replace their job, but that's rare. If you only have a few $1,000s, even big gains won't change your life. A 10% return on $5,000 is $500. That's not enough to live on, or pay big bills. To grow wealth, you need capital, or you need time for small amounts to compound. But compounding works slow in the beginning, then grows bigger. But it takes years. Some people use leverage to grow faster. They borrow money to invest, but leverage cuts both ways. If your investment rises, you make more. If it falls, you owe more than you invested. You can lose everything. That's why professional investors use leverage carefully, and only after they have systems to protect themselves. At the passive path, we believe investing is not magic, it's math. Small money means small returns, until your base grows. So focus first on building income, saving money, creating a strong base, then invest, so you never have to pull money out at the worst time. Next, we'll look at how the future belongs to those who understand the internet, and why knowledge and the internet changed everything. Before the internet, starting a business meant big money, renting space, buying equipment, hiring staff. Now anyone can start with a laptop and reach the world. Digital products cost almost nothing to deliver. An online course, an ebook, a video channel. They can all earn money while you sleep. That's real passive income. The internet removes middlemen. You can sell directly to people who want what you offer. No store needed, no warehouse, no shipping trucks. It's all digital. Artificial intelligence is speeding this up. AI can write text, make videos, create music, design images. It saves time and makes small businesses look big. People who learn to use AI have an edge because they can create more with less effort. This is the future of work. People will work for themselves, not for one employer. They'll have multiple income streams, all tied to their skills and creativity. Self-media is growing fast. They share knowledge, or entertain, or teach skills. Followers become customers. Income grows from ads, sponsorships, and products. Even a small audience can bring steady income, because trust matters more than size. The future economy will reward those who know things others don't. Special knowledge, unique skills, or a fresh voice. At the passive path, we believe the internet is the biggest chance for everyday people to change their lives. You don't need millions to start. Just time, consistency, and a willingness to learn. Knowledge and digital skills are the new gold. Those who grab them early will lead the next generation of wealth. Next, we'll talk about one final truth. Why money alone isn't the ultimate power, and why understanding who writes the money is power. But power is more than money. The real power belongs to those who write the rules. In history, kings ruled because they held armies, but behind the throne were the financiers. They lent money, funded wars, controlled trade routes. They held kings in debt. Debt gave them influence. Over time, the financiers became more powerful than the kings themselves. Because kings changed, but debts remained. Today, governments print money. They borrow trillions. Banks lend money created from thin air. Central banks decide interest rates. They steer economies up or down. A few people shape policies that affect billions. This is the modern version of writing the rules. The rich stay rich because they understand this game. They position themselves close to those who hold influence. Or they become the rule makers themselves. They create financial products. They design markets. They manage the flow of information. Meanwhile, most never question who wrote those rules or why. Look at big tech companies. They decide who sees what online, they control data, they shape public opinion. That's power beyond money. At the passive path, we believe knowledge is your best defense. When you know how the system works, you can protect yourself. You can spot opportunities others miss. You can avoid traps set by those who profit from your ignorance. Because true wealth isn't just money, it's freedom. Freedom to choose your path. Freedom to live life on your own terms. The world will keep changing. New technologies will rise. Markets will boom and bust. But the patterns remain the same. Those who control the rules win the game. Everyone else pays the price. So keep learning. Keep questioning. Keep building your own path. Because no one cares more about your money than you do. At the passive path, we'll keep sharing what we learn. So you can build wealth that we've covered a lot today. From the birth of stocks, to how fear and greed shape markets, to how power writes the rules of money. The world of finance can look complex, but at its core, it's people, their decisions, their emotions, their actions. At the passive path, we believe knowledge sets you free. It helps you protect your money and grow it with confidence. So keep learning, keep asking questions, and never stop building your path to freedom. If you found this video helpful, like it, subscribe to the passive path, leave a comment with your thoughts or questions, and share this video with someone you care about. I wish you luck on your journey to financial freedom. Feel free to explore other videos on the channel.